The number one mental mistake that destroys trading accounts isn't lack of strategy, poor timing, or even bad luck. It's something far more subtle, hidden deep inside the human brain. It's the same force that drives gamblers to chase losses, entrepreneurs to overexpand too quickly, and everyday people to check their phones hundreds of times a day. It's dopamine, the brain's currency of anticipation and reward. When a trader learns how dopamine truly works, they stop chasing excitement and start mastering consistency. But when they ignore it, their trading account becomes an emotional playground for impulses masquerading as logic. Most traders don't fail because they don't know what to do. They fail because they can't consistently do what they already know. Every losing streak, every impulsive entry, every premature exit is rooted not in ignorance but in a hijacked nervous system. And that's why understanding dopamine is not just neuroscience, it's survival. Neuroscientists at Stanford found that dopamine isn't released when you win. It's released when you anticipate a win. In trading, this means your brain spikes dopamine not when the candle closes green, but when you think it might. That tiny rise in anticipation creates an intoxicating rush. It feels like confidence, but it's actually chemical manipulation. The same mechanism drives people to check their phone notifications, gamble on slot machines, or refresh charts compulsively. Each time you anticipate a reward, your brain gives you a dopamine drip, a subtle whisper saying maybe this next trade will be the one. And that whisper is what destroys accounts. Because dopamine doesn't care about rationality, it only cares about uncertainty mixed with potential reward, the exact formula of trading markets. Psychologists call this variable reward reinforcement. It's the same principle casinos use. You don't win every time, but when you do, the reward is unpredictable. This unpredictability makes your dopamine system hyperactive. B.F. Skinner proved this decades ago with pigeons. When rewards were consistent, the pigeons pecked the lever calmly. But when rewards were random, they became obsessed, pecking frantically even when no food appeared. Now replace the pigeon with a trader and the lever with the buy button. The same mechanism plays out. Charts become the lever, and profits the food pellet. You're not trading financial instruments anymore. You're trading dopamine cycles. Every trader begins their journey logically. They learn charts, study setups, and maybe even backtest a system. But the moment real money enters the picture, the brain transforms. Fear and greed are easy words, but they're only surface-level expressions of deeper neurochemical chaos. Dopamine tells you to seek reward. Cortisol warns you to avoid pain. The tug-of-war between these two chemicals determines your behavior more than any trading strategy ever could. The brain starts predicting outcomes instead of observing them. You stop trading what you see and start trading what you hope to see. In 2018, researchers at MIT examined the behavior of 2,000 retail traders over a span of 12 months. They found that 82% of them lost money, not because their entries were terrible, but because they exited inconsistently. Most traders violated their own rules within the first 30 days. When asked why, the most common answer was, "I felt like this one would work." That phrase, "I felt like," is the death sentence of a trading account. Because feeling like something will happen isn't intuition. It's dopamine rationalizing impulse. The traders weren't consciously self-sabotaging. Their biology was simply stronger than their discipline. Think of dopamine as both fuel and fire. It gives you energy to act, but if left unregulated, it burns your structure down. In trading, it manifests as overconfidence after a win and revenge trading after a loss. Both behaviors come from the same source, the craving for another hit of reward. A study published in Nature Neuroscience revealed that when people experience a near miss, like almost winning, dopamine activity spikes even higher than when they actually win. That means after a trade barely stops you out, your brain is flooded with even more anticipation. That's why traders often re-enter too quickly after a loss. Their brain chemistry is screaming for resolution. They don't want to regain money, they want to regain dopamine equilibrium. The market becomes their chemical regulator. Let's take an example. Imagine a trader named David. He's disciplined, analytical, and risk-conscious. He's been trading for months and follows a strict plan. But one day, he catches a massive breakout, a trade that triples his weekly target in a single afternoon. The rush he feels is indescribable. His brain releases a surge of dopamine, reinforcing every step that led to that win. The pattern is set. Next time, his brain will crave that same high. Even if the setup isn't perfect, he'll feel drawn to click buy because his neurochemistry now associates trading with euphoria. Within weeks, he's no longer trading a system, he's trading a feeling. And that's how consistency dies. Not through ignorance, but through biochemical conditioning. The tragic irony is that success can be more dangerous than failure. A losing streak humbles you, but a sudden win intoxicates you. It rewires your neural pathways, convincing you that you've figured it out. You stop measuring risk, stop journaling, stop waiting for confirmation. The dopamine rush tells you you're invincible, just as it did to over-leveraged traders before every market crash. Studies of professional poker players show a similar pattern. Their brain scans during big wins light up in the same regions activated by cocaine in addicts. The parallel is alarming. Both are chasing the same neurotransmitter. Trading is simply a more socially acceptable addiction. Dopamine isn't evil. It's evolution's motivator. It's what drove humanity to explore, build, and innovate. But in modern markets, it's a liability unless harnessed. The problem is that dopamine spikes on expectation, meaning you can lose money and still reinforce bad habits if the trade felt exciting. Conversely, you can make a disciplined, boring trade that wins modestly and feel nothing, so your brain doesn't learn from it. This asymmetry creates a devastating loop. You're chemically rewarded for impulsive risk and emotionally bored by rational execution. That's why traders say consistency is boring. It is, because it doesn't give your brain the fireworks of uncertainty. Behavioral finance researchers like Daniel Kahneman and Richard Thaler have proven that humans are not rational investors, they are emotional predictors. Kahneman's prospect theory shows that people feel losses twice as intensely as gains. That means a $100 loss hurts as much as a $200 gain pleases you. This imbalance drives traders to hold losers too long and cut winners too early, both acts of emotional avoidance rather than strategy. It's not stupidity, it's biology. The dopamine hit from avoiding short-term pain outweighs the logical reasoning for long-term gain. This is why traders who know exactly what to do still can't do it. Knowledge doesn't override neurochemistry, awareness does. The great entrepreneurs of history understood this principle instinctively. Steve Jobs was obsessed not with dopamine spikes but with flow, a state of deep engagement where the brain stops chasing novelty. Elon Musk, despite his risk tolerance, is structured by data loops and feedback systems that enforce consistency. Warren Buffett famously said, "The stock market is designed to transfer money from the active to the patient." That's not philosophy, it's neuropsychology. The patient trader experiences fewer dopamine spikes, fewer cortisol crashes, and thus more stability. Buffett once mentioned that he reads for 6 hours a day not because it's thrilling, but because it keeps him detached. Detachment is the antidote to dopamine-driven decision-making. In behavioral studies, long-term investors who check their portfolios less than once a month outperform those who check daily by an average of 18% annually. The reason is simple. Less exposure to fluctuating data means fewer emotional triggers. Your brain can't chase what it doesn't constantly see. In contrast, active traders open dozens of dopamine loops each day. Every chart refresh, every tick, every notification. Each open loop is a potential anxiety source. The brain becomes addicted not to profits but to stimulation. And stimulation costs focus. Now, let's talk numbers. According to data from the North American Securities Administrators Association, 70% of day traders lose money consistently, and 95% quit within 2 years. The average lifespan of a new trading account? Less than 6 months. These aren't random failures. They are neurochemical inevitabilities for anyone who hasn't learned to manage emotional variance. Most traders think they need a better strategy, but what they truly need is better state control. The difference between a novice and a professional is not knowledge. It's emotional bandwidth. Professionals treat boredom as a signal of discipline. Amateurs treat it as a problem to solve. And when boredom meets dopamine craving, chaos follows. To understand how this plays out at scale, look at a 2021 study by eToro analyzing 4.5 million trades. Traders who frequently switched strategies performed 23% worse than those who stayed consistent, even when using average performing systems. The constant switching was not strategic. It was psychological. Dopamine made them chase novelty. They equated change with improvement because the brain rewards newness with chemical satisfaction. But markets reward consistency, not novelty. Every time you change systems after a few losses, you're not adapting. You're escaping the discomfort of uncertainty. Imagine if Jeff Bezos changed Amazon's business model every month because sales dipped. He'd have no empire. Yet traders do exactly that, abandoning systems before data can mature. The cognitive bias here is called action bias, the belief that doing something is better than doing nothing. It's dopamine in disguise. Real professionals know that sometimes the most productive action is stillness. In fact, elite traders spend 80% of their time waiting and only 20% acting. Their profits come not from a number of trades but from the quality of emotional restraint. The markets don't reward the smartest, they reward the most stable. Let's explore the brain more deeply. The ventral tegmental area, VTA, releases dopamine to the nucleus accumbens when anticipating reward. This pathway evolved to help us survive, hunt, gather, reproduce. But in the market, it interprets price movement as potential food. Each green candle becomes prey, each loss a predator. Your ancient brain is playing a survival game in a digital arena. Modern traders are running Stone Age software on 21st century hardware. That's why logic alone fails. You can't outthink millions of years of evolution. You must reprogram your responses. Reprogramming begins with awareness. The goal isn't to eliminate emotion but to detach behavior from it. Dopamine can be redirected. When neuroscientists train subjects to associate small, consistent wins with satisfaction, the subjects' brains began releasing dopamine for stability, not novelty. Traders can do the same. Instead of chasing massive profits, they can retrain their brain to find reward in execution quality. Every time you follow your plan flawlessly, your brain should receive a reward signal, not because of the outcome, but because of the discipline. Over time, this rewires your reward system to favor consistency over excitement. That's how professionals are built. Let's go practical. Think of a trader's morning routine. The average amateur wakes up, checks charts before brushing teeth, and scrolls through social media filled with success screenshots. Each post is a dopamine hit waiting to hijack his confidence. His brain begins the day in a reactive state. The professional, in contrast, wakes up, avoids screens for at least an hour, and ground himself through routine, journaling, reviewing rules, visualizing execution. This isn't spiritual fluff. It's neurochemical armor. By stabilizing baseline dopamine early in the day, he reduces impulsive variability later. Studies show that traders who meditate for just 10 minutes daily reduce cortisol spikes by 30% and increase decision accuracy by 18%. Meditation isn't just calmness, it's cognitive regulation. Another factor is sleep. Sleep deprivation lowers prefrontal cortex activity, the region responsible for self-control, by up to 40%. Meanwhile, the amygdala, which drives emotional reactions, becomes 60% more active. That means a tired trader is 60% more emotional and 40% less rational. No strategy survives that imbalance. Even caffeine can amplify dopamine fluctuations, leading to overconfidence followed by fatigue. Professionals treat their body like part of their portfolio, because it is. Biological capital determines mental capital. Entrepreneurs like Ray Dalio and Paul Tudor Jones know this well. Dalio's hedge fund, Bridgewater Associates, enforces radical transparency, not as a moral code but as a cognitive regulation system. By exposing mistakes publicly, Traders reduce the ego's dopamine attachment to being right. The environment rewards truth over emotion. That's why Dalio said, pain plus reflection equals progress. Pain is information when processed correctly. But when numbed with dopamine, it becomes addiction. Every trader who blames the market instead of analyzing behavior is protecting their ego's chemical comfort zone. Growth begins where that zone ends. Let's quantify the impact of emotional trading. A study by the University of California found that individual investors who sold stocks after recent price declines underperformed the market by 3.4% annually. Why? Emotional reactions, not data, drove their timing. Another analysis by Fidelity discovered that the best-performing accounts often belonged to people who forgot they had an account. That's not irony, it's proof. Less emotional involvement equals better performance. The less you feel, the more you earn. So why is consistency so difficult? Because dopamine is programmed to crave contrast. The brain doesn't care about absolute value. It cares about change. A $100 gain after losing $1,000 feels euphoric, but a $100 gain after winning $1,000 feels boring. This is called hedonic adaptation. You adapt to success quickly, so you keep seeking new highs. That's why lottery winners often end up broke. They adjust to wealth emotionally faster than they adapt to managing it. Traders do the same. They increase position size after wins, chasing the same intensity. But as position size grows, so does stress. Cortisol rises, heart rate accelerates, perception narrows. Decision-making becomes tunnel vision. The trader mistakes adrenaline for clarity. And that's when ruin hides behind euphoria. In 2022, neuroscientist Dr. Anna Lemke described in her research on addiction that dopamine deficit states occur when reward circuits are overstimulated. After repeated dopamine spikes, your baseline pleasure drops. The brain compensates by seeking bigger risks to feel normal. This is exactly what happens to traders who keep increasing leverage or trading more frequently. Their tolerance rises. They need more excitement to feel the same rush. Eventually, they're no longer trading markets. They're self-medicating boredom. Every impulsive click is a chemical craving disguised as intuition. That's why consistent traders often appear emotionally flat. They don't chase highs because they understand that neutrality equals longevity. They replace excitement with execution. They know that real confidence is quiet, not loud. It's data-backed, not dopamine-fed. They treat trading as probability management, not prophecy. Each trade is one data point in a long statistical curve, nothing more. Professionals don't celebrate single wins because they know a single trade means nothing. They're more impressed by a flawless month of following rules than by one big payday. And ironically, this humility becomes their edge. There's a saying among elite performers, discipline is remembering what you want. In trading, what you truly want isn't a quick profit. It's freedom, mastery, stability. But dopamine makes you forget that. It tricks you into chasing short-term sensations that sabotage long-term goals. You're not just fighting markets, you're fighting evolution. Consistency means learning to override impulses that once ensured your ancestors' survival. The modern battlefield isn't outside, it's in your own prefrontal cortex. The most successful traders are those who internalize this war and structure their environment to win it. They automate decisions wherever possible to reduce emotional input. They predefine entries, stops, and exits so that dopamine never gets a vote. They design checklists and journals not for memory but for accountability. Behavioral psychologist B.J. Fogg calls this environmental design, shaping surroundings to shape behavior. If your trading screen shows P&L in real time, hide it. Studies show that traders who hide profit or loss data perform 16% better because their brain focuses on process, not outcome. The brain can't crave what it can't see. The third strategy used by professionals is ritualized review. After each session, they analyze not only trades but emotional states. Did I follow my plan? What emotion was strongest before each entry? What triggered deviation? Over time, patterns emerge. Maybe frustration leads to overtrading. Maybe boredom triggers premature entries. These insights aren't motivational fluff, they're data for self-optimization. Every emotional mistake, once documented, loses power. What gets measured gets managed. When you combine these elements, environmental design, emotional tracking, and reward reframing, you begin rewiring your dopamine circuits toward consistency. Your brain stops seeking excitement and starts seeking accuracy. And when that shift happens, everything changes. You no longer feel anxiety when waiting for setups because waiting itself becomes satisfying. You no longer fear missing out because your metric for success isn't profit, it's execution quality. You start seeing the market as a mirror of your inner state. When your mind is calm, your trades are clean. When your mind is chaotic, your account reflects it instantly. Every candlestick becomes feedback from your own nervous system. Consistency is not built through intensity, it's built through identity. You don't force discipline. You become someone for whom discipline is natural. Identity-based change, as described by James Clear in Atomic Habits, means you stop saying I need to be more disciplined and start saying I'm the kind of trader who follows his plan. The brain responds differently to identity statements. They trigger self-consistency bias, a powerful cognitive force that makes you act in alignment with who you believe you are. That's why affirmations fail but identity shifts work. You can't trick your brain with words. You must prove them with behavior. Every time you act in alignment with your rules, you reinforce that identity until it becomes reflex. To illustrate this, consider professional tennis players. They don't feel excitement before serving match point. They feel presence. Their dopamine curve flattens because repetition has replaced novelty. That's what traders must emulate: detachment through repetition. When your routine is sacred, emotion becomes background noise. And just like in sports, the mental game decides everything. Studies from the Journal of Behavioral Finance found that traders who incorporated structured visualization before sessions increased win rates by 12%. Visualization isn't fantasy. It's preloading your neural pathways for calm execution. Your brain rehearses stability before chaos begins. The human brain has about 86 billion neurons, each capable of forming thousands of connections. Every repeated behavior strengthens specific neural circuits. When you act impulsively, you're strengthening impulsivity. When you act patiently, you're strengthening patience. Every click, every thought, every hesitation carves neural grooves deeper into habit. Your trading results are simply the reflection of which grooves dominate your brain. Neuroscientists call this synaptic plasticity. Neurons that fire together, wire together. The longer you stay consistent, the stronger those patterns become, until discipline is no longer something you force, it's something you are. That's how mastery is born. Not from intensity, but from repetition sculpted by awareness. This is why elite traders appear calm in chaos. They've trained their neural architecture to remain stable no matter what their balance sheet says. The charts don't dictate their state dictates how they read the charts. Think about what that means on a practical level. The trader who feels anxious watching a candle move is not reacting to price. He's reacting to internal prediction error. The brain hates uncertainty because uncertainty means potential threat. Dopamine's job is to predict rewards and update those predictions. When the market moves unexpectedly, the prediction error fires like an alarm. You feel it as anxiety or excitement, but it's really your brain recalibrating probabilities. The mistake most traders make is interpreting that chemical signal as intuition. It's not intuition, it's instability. Professionals recognize it instantly and let it pass, while amateurs act on it, thinking it's insight. Behavioral economic studies show that human decision-making under stress can degrade accuracy by up to 40%. In trading, that's catastrophic. A single impulsive trade can wipe out weeks of disciplined effort. Yet the same study found that traders who practice mindfulness before sessions maintain stable accuracy even during volatile markets. Their brain activity showed stronger prefrontal regulation and weaker amygdala activation. In simple terms, they had trained themselves to feel the emotion but not obey it. That's the difference between reactive traders and deliberate ones. The first are puppets of their neurochemistry. The second are masters of it. Let's go back to dopamine. Remember, it spikes at anticipation, not reward. The market exploits this beautifully. Every flashing number, every tick, every green bar is designed to trigger micro-anticipations. Platforms know this. That's why interfaces use bright colors, sounds, and animations, the same psychological design principles as social media apps. Each tiny change stimulates a dopamine burst, keeping you engaged, clicking, trading. You're not competing against other traders. You're competing against billion-dollar behavioral design teams. That's why awareness isn't optional. It's essential defense. When you realize the market environment is literally built to hijack your reward system, you start protecting it like capital. You set rules, limit chart time, disable sounds, remove price alerts, trade from plans instead of impulses. At this point, many ask, if dopamine drives action, how can we trade without it? The goal isn't elimination, it's redirection. Dopamine is powerful fuel when aimed correctly. You don't suppress it, you align it with the right targets. Instead of rewarding the thrill of uncertain profit, you condition your brain to reward consistency, precision, patience. Over time, your brain learns that calmness is pleasure, not chaos. This is neurochemical transmutation, turning addiction into discipline. One of the most striking examples comes from George Soros. He once said he knew when a position was wrong because his back pain would flare up. That sounds mystical, but physiologically it makes sense. Chronic traders develop somatic markers, physical sensations tied to emotional states. Soros had trained his body to notice tension before his mind rationalized it. That awareness allowed him to exit early, protecting billions. Awareness is profit. Similarly, Jesse Livermore, the legendary speculator, documented that his biggest losses always came after emotional highs. After I'd made a big win, I felt I had to play more, he wrote, and that's when I gave it back. They were describing dopamine long before neuroscience caught up. To build the kind of consistency that survives decades, traders must build systems that regulate emotion automatically. The best do it through 3 intertwined habits: structured environment, deliberate reflection, and process-based reward. Let's unpack how these shape neurochemistry. Structured environment means every variable that can trigger impulsivity is minimized. Charts are clean, notifications off, trade size predetermined. There's no room for guesswork. This removes ambiguity, the biggest dopamine stimulator, and replaces it with clarity. Deliberate reflection means you treat trading like scientific research. Every session ends with a log. What rules were followed, what emotions surfaced, what thoughts occurred right before mistakes. You're not judging, you're collecting data. Over weeks, you'll notice emotional fingerprints, patterns that predict self-sabotage. Maybe you overtrade after arguments, or take revenge trades after lunch. Once recognized, they can be preempted. The third habit, process-based reward, is the most transformative. It means you consciously praise yourself not for winning trades but for flawless execution. When you follow your plan precisely, even if it loses, you celebrate it. That tells your brain, this behavior brings satisfaction. Over time, dopamine attaches to discipline, not outcome. And when that happens, trading stops feeling like gambling and starts feeling like craftsmanship. You're shaping probability with patience, and every day of alignment compounds neural stability. Consider what happens chemically during a losing streak. Dopamine drops, cortisol rises, serotonin declines. You feel agitation, fatigue, doubt. The untrained trader responds by seeking stimulation, trading more, scrolling more, consuming more information. Each action spikes dopamine temporarily but deepens the deficit afterward. It's like taking caffeine to fix sleep deprivation, short-term relief, long-term damage. The professional does the opposite. They withdraw stimulation. They rest, review, detach. They let baseline dopamine reset. That's why after drawdowns, elite traders take days off intentionally. They understand the brain's recovery curve. You can't outtrade chemistry. You must cooperate with it. There's also the myth of intuition, the idea that gut feeling separates pros from amateurs. In truth, what people call intuition is pattern recognition trained by repetition. The brain's basal ganglia detect patterns far faster than conscious reasoning. When a veteran trader senses a setup instantly, it's not mystical. It's thousands of logged hours encoded into neural efficiency. But this intuition only works if built on consistent, structured data. Without discipline, intuition is just impulse wearing a costume. Now let's look at an experiment from Cambridge University that measured traders' hormone levels during real-time market activity. Testosterone spiked after profits, increasing confidence. But when combined with elevated cortisol from risk, it led to reckless behavior. The study concluded that hormonal feedback loops amplify financial bubbles. In other words, markets become chemical ecosystems where collective dopamine and testosterone surges inflate irrational trends. Each trader contributes a microburst of emotion that merges into macro volatility. Understanding this helps you detach, realizing every candle is partly human chemistry visualized. You're watching a brainwave chart of global emotion. When you see it that way, you stop fighting the market and start observing it like weather. The irony is that traders often think emotional neutrality means apathy, but it's the opposite. True neutrality is controlled engagement, fully present yet unreactive. It's the state Buddhist monks describe as equanimity and athletes call the zone. Neuroscience labels it as a balanced dopamine baseline with synchronized prefrontal and limbic activity. It feels calm but alert, detached but aware. Achieving it consistently is the trader's highest skill. And like any skill, it's trainable. Here's how it manifests. The untrained trader experiences spikes, euphoria, despair, boredom, urgency. Their performance graph looks like a roller coaster. The consistent trader's graph looks like a steady heartbeat, minor ups and downs, but no violent swings. That's because they manage internal volatility first. The market's volatility becomes irrelevant once internal volatility is low. It's like sailing. You can't control the wind, but you can control your sail. Let's take a macro example. During the 2020 COVID crash, global markets dropped over 30% in weeks. Panic dominated. Yet a handful of traders made extraordinary returns, not because they predicted the crash, but because they stayed functional when everyone else froze. They had pre-planned crisis protocols. No emotional improvisation. Their dopamine systems were stable enough to execute rationally while others drowned in cortisol. It wasn't IQ that saved them. It was EQ, emotional intelligence measured in neurochemical stability. You can apply this to entrepreneurship too. When Elon Musk was weeks from bankruptcy at Tesla, he didn't chase dopamine highs. He said he felt fearful but focused. That's the difference between reactive and reflective. Dopamine makes you seek escape. Discipline makes you seek solution. Musk built micro-routines, daily engineering reviews, structured communication, to anchor himself in process. That same principle saves trading accounts. When chaos rises, you narrow focus to controllables: risk, execution, patience. Now, let's explore the hidden cost of dopamine dependency: time distortion. High dopamine activity compresses perception of time. That's why 2 hours of chart watching feels like 20 minutes. You think you're in the zone, but really you're overstimulated. This leads to fatigue, poor decisions, and impulsive late-session trades. The antidote is time segmentation, setting hard boundaries. Professionals trade in blocks: enter, monitor, review, then disconnect. They treat trading like surgery: precise, contained, detached. Once finished, they step away completely to let neurochemistry reset. There's a fascinating correlation between dopamine and uncertainty tolerance. In 2019, a study in Neuron found that people with higher baseline dopamine were more comfortable making risky decisions, but also more prone to overestimating control. In trading, that translates to overconfidence after success. You believe your edge is stronger than it is, leading to oversized positions. That's not courage. It's chemistry. Awareness of this pattern can save months of losses. The mind whispers you've got this, but what it really means is I want another hit. The disciplined trader listens but doesn't obey. They note the urge, breathe, log it, and act only if it aligns with plan parameters. The concept of urge surfing, coined in addiction therapy, applies perfectly. When a craving arises, to trade, to check charts, to win back losses, you don't resist or indulge it. You observe it. You ride the wave of sensation without acting until it passes. Typically, a craving lasts 90 seconds if unreinforced. Most traders can't endure that minute and a half. They click to escape discomfort. But if you can outlast that wave, you rewire your brain for resilience. Each resisted impulse lowers its future intensity. In time, the urge fades permanently. That's neuroplasticity in action. Let's connect this to business leadership. The best CEOs and investors operate from delayed gratification. Jeff Bezos famously said, "We are willing to be misunderstood for long periods of time." That's anti-dopamine thinking. It means resisting short-term applause for long-term vision. The same principle wins in markets. You delay gratification not just financially, but chemically, refusing short dopamine loops in exchange for strategic serenity. Dopamine wants speed. Wisdom demands slowness. Even Benjamin Graham, mentor to Warren Buffett, wrote in 1949 that the investor's chief problem, and even his worst enemy, is likely to be himself. Decades before neuroscience, he understood the mind as the battlefield. Buffett later expanded, "Success in investing doesn't correlate with IQ once you're above 125. Temperament matters more." That temperament is nothing more than emotional regulation. Dopamine doesn't care about IQ. It cares about triggers. Temperament is trained tolerance for boredom and uncertainty, the two conditions where dopamine screams the loudest. To ground this in reality, consider this numerical model. Suppose two traders start with $10,000 each, both averaging 2% gain per month. Trader A breaks rules once a month due to impulse and loses 10% of capital each time. Trader B never breaks rules. After 1 year, Trader B ends with roughly $12,682. Trader A ends with $9,331. Same system, different brain chemistry. The edge wasn't strategy, it was stability. That's the compound interest of discipline. Let's look at brain imaging data. Functional MRI scans of professional traders show reduced activation in the nucleus accumbens compared to novices during winning trades. In simple terms, pros' brains react less to reward. They've desensitized dopamine spikes. This isn't dullness, it's mastery. Their nervous system has learned that emotional neutrality increases survival probability. They experience smaller highs, smaller lows, and exponentially greater longevity. That's why seasoned traders often describe markets as boring. But boring is good. Boring is profitable. Now let's translate all this science into 3 real-world strategies to build consistency. The first is schedule dopamine. Set specific times for market engagement and information intake. No random scrolling, no after-hours analysis. By restricting stimulation windows, you train the brain to release dopamine predictably instead of chaotically. Over weeks, this stabilizes motivation and reduces cravings. The second strategy is micro-rewards for macro-discipline. Each day you follow your plan perfectly, give yourself a small pleasure, a walk, a coffee, a song. That small reward becomes the dopamine link that reinforces discipline. The trick is to make the reward unrelated to markets, so your satisfaction detaches from outcomes. You begin associating dopamine with process, not profit. The third strategy is slow exposure. Gradually increase tolerance for boredom and uncertainty. Start by watching charts without trading for 30 minutes daily. Observe emotions rise and fall without reacting. This rewires dopamine receptors for patience. After a few weeks, your baseline anxiety decreases, and market noise loses its power. You transform from reactive participant to detached observer. These aren't theories. They're proven behavioral interventions used in performance psychology, addiction recovery, and elite sports. They shift your nervous system from reactive to responsive. And once you master that shift, markets stop feeling like enemies. They become mirrors reflecting your level of internal control. Here's the ultimate paradox. When you stop needing to trade, you start trading better. When you stop craving profit, profit flows more easily. The market rewards detachment because detachment aligns with statistical logic. Each trade becomes just one roll in a long-term probability game. The less you emotionally invest in individual outcomes, the more your account grows consistently. That's the quiet magic of discipline psychology. The numbers follow the nervous system. Think of trading as a physiological sport. Your breathing, sleep, nutrition, movement, all influence chemistry. Exercise releases dopamine in a balanced way, improving focus and reducing cravings. Even walking 20 minutes before trading stabilizes prefrontal control. Hydration affects cognitive speed. Small biological optimizations compound into massive financial outcomes. The professional trader trains like an athlete, body, brain, and behavior in harmony. The deeper truth is that markets are neutral. They don't punish or reward, they only reflect. If your inner world is chaotic, markets amplify it. If your mind is still, markets appear still. The difference between heaven and hell in trading is not the chart. It's your perception of it. That's why mastery begins with self-regulation. Every tick is feedback. Every emotional reaction is a clue. The market is your therapist if you listen carefully. When traders finally internalize this, everything slows down. They stop forcing trades. They start waiting like hunters, patient, precise, detached. Their dopamine curve flattens, their account curve rises. They realize that consistency isn't built from motivation, it's built from regulation. Motivation fluctuates. Regulation sustains. Science tells us the average human makes about 35,000 decisions per day. Every decision costs glucose and willpower. This is called decision fatigue. By automating your trading rules, you can conserve mental energy for the few moments that matter. Each saved decision protects you from impulsive error. Professionals automate to save sanity. Their routines act as exoskeletons for willpower. Let's conclude this half of our journey with one core realization. The enemy isn't fear or greed, it's uncontrolled dopamine. Fear and greed are symptoms. Dopamine dysregulation is the cause. Master that, and the entire game changes. The traders who survive decades aren't necessarily the smartest or luckiest. They're the ones who understood their own biology. They built systems around it, respected it, and transcended it. Consistency isn't an act, it's chemistry disciplined into routine. The trader's evolution moves from excitement to awareness, from awareness to control, and from control to mastery. The markets remain the same, but the mind transforms. And in that transformation lies freedom, the quiet, unshakable confidence that no matter what the chart does, you will remain the same person tomorrow, next year, and for decades to come. Because you've stopped chasing dopamine and started mastering yourself.